Hello students, this is Professor Vicente Saga. Welcome to my class. This is the presentation of part 1 of chapter 15, Stockholders Equity. As you know, the main objective of this course is threefold. Number 1, we are to understand the underlying accounting principles relative to a particular subject matter and how to apply the accounting principles. Then number 2, based on our understanding and the application of the accounting principles, we then need to be in a position to be able to prepare the underlying financial statements and the related notes to the financial statement or disclosures in accordance with GAAP. Then number 3, we then analyze or interpret and analyze and interpret the financial statement, essentially talking about what the numbers actually mean. So that is basically the overview of the chapter. Now the financial statement on hand relative to chapter 15, of course, is the balance sheet. As we discussed in the previous chapter, we have assets, liabilities, stockholders' equity, the 3 elements of the balance sheet. In chapter 13, we talk about the accounting principles and their applications regarding current liabilities. Then in chapter 14, we shift gear and talk about long-term liabilities. Then in chapter 15, we are going to move now from the liability component of the balance sheet and talk about chapter 13, chapter 14, and talk about stockholders' equity section of the balance sheet. This is not in your textbook, but I just want you to know from the outset at this point in time that for a corporation, we call this third element stockholders' equity. However, for a partnership type of business, we call it partners' equity. Now, for a sole proprietorship, we are going to talk about different forms of business. We call it owner's equity. Then furthermore, for a non-for-profit organization, we have another special name for it, and we call it net assets. Okay, those issues are not discussed in your textbooks. Those are extras. You didn't pay for that additional information. Now, moving along, now that we have talked about the overview of the course and what we are trying to accomplish here, let us now take a look closely at the specific objectives of this chapter. Number 1, we are going to talk about the characteristics of a corporate form of business. Then we are going to identify the key components of stockholders' equity. Then we are going to discuss extensively the accounting principles for issuing stock, talk about treasury stock, talk about how to account and report a preferred stock, talk about the policies that we use in distributing dividends. We are going to talk about different forms of dividend distributions, small, large stock dividends. We are going to talk about that and stock split. And then ultimately, we talk about how to analyze and interpret stockholders' equity. So that is the overview. So let's take a look at the first objective of this chapter, the corporate form of business. Before we do that, let me back up for a minute. I just want to let you know from the outset that this chapter is divided into 5 sessions. The first section talks about the corporate form. Second section talks about corporate capital, preferred stock dividend policy, presentation, and analysis. Now, moving along, let's take a look at the corporate form of a business. We said that there are 3 forms of business organizations. Okay, what does that mean? That simply means you have 3 different ways of setting up any particular business. In other words, every company that you have out there is being set up in 1 of 3 ways. Number 1, proprietorship. Number 2, partnership. Number 3, corporation. They are different in a very simplified manner. there are different types of partnerships. You know, for example, you have a limited liability partnership, you have general partnerships, so on and so forth. And we also have different types of corporations: S corporation, C corporation, personal service corporation, so on and so forth. We are not going to get into all those details here. We are just going to make this as simple as possible. The most important thing that you need to know here is the fact that we have three ways of setting up any type of company. So if someone to approach you and say, well, I'm interested in starting a company, one of the questions that will come up would be, how do I set up this company? So there are advantages and disadvantages of each option, and there are different tax and legal ramifications of each option as well. Those issues are beyond the scope of this topic of this chapter. So moving along, briefly, we said that the proprietorship is a company that is owned by one person. In addition to that, it doesn't have to be formally set up through the government. So that is a proprietorship. It's a company. The owner of the proprietorship is called the proprietor. Partnership is a company that is owned by two or more persons. One of the owners of the partnership is called the partner. Corporation, another type of company, and that is where the one that we are going to zero in on in this chapter. The corporation is a special type of company that has to be brought up into existence through the state laws. In other words, you have to complete the necessary applications and send it to the state for approval. Upon approval, before you can call your company a corporation. All right. So here are some of the characteristics of a corporate type of business. Number one, influence of state corporate law. In other words, it has to be brought into existence by the state through the state law. Use of capital stock or share system. We are going to talk more about that in a minute. Meaning that the ownership of the company can be split up into different units, which could be made available to a lot of investors. Then number three, development of a variety of ownership interests. I just talked about that. So that is the overview. Now let's take a look at the state corporate law. Like I said, for you to organize your company as a corporation, you have to do some paperwork, or you have to complete some documents and submit it to the state government. Each state has their own regulations. So the application is called Articles of Incorporation. By the time it is approved by the state will issue you what we call a corporation charter, meaning an approval of your application. Okay? Now, like I said, each state have their different laws as to how you need to set up a corporation, or the requirement to set up a corporation. And here we are told that the state of Delaware laws usually favor the corporate form of business organization the best. So accounting for stockholders' equity allows provision of each state business incorporation act. So moving along, let's take a look at the corporate stock or share system. So what are we talking about here? We said that in the absence of restrictive provisions, each share carries the following rights. Now, before we talk about that, let's make a distinction between stock and share. All right? So the question is, what is stock versus share? Okay? These two words are used interchangeably, but in actuality, both of them means different things. A stock is a certificate, a piece of paper. Like I said, it's a certificate that shows there is an evidence that you have an ownership of a corporation. So if you go to downtown and buy IBM stock, you give IBM X amount of dollars and they give you a piece of paper. That is stock. That is a certificate. It's evidence that you have ownership in IBM. All right, now let's take a look at the definition of share. Even though the two words are used interchangeably, their meanings are different. A share is a unit of stock. So if I go to downtown and buy 100 shares of IBM, and you go to downtown and buy 5 shares of IBM stock, obviously I have more ownership of IBM than you. So the share is a unit of stock, and that is how we determine how much ownership of a corporation that you have. So that is capital stock or share system for you. So basically, by the time you buy a company stock, obviously you are entitled or you have some rights. And here are some of the rights. Number one, to share proportionately in profit and losses, meaning when the company makes profit and the part of the profit or all of the profit is distributed to the owners, then you get a piece of it based on your ownership percentage. Number two, to share proportionately in management. So you are able to participate in management by way of you voting for individuals that are brought up to become a board of directors. Now, number three, to share proportionately in assets upon liquidation. What does that mean? When the company goes belly up, as one of the owners or as a stockholder, or we say shareholder, then you also have the right to partake of whatever is left after all creditors have been paid. Number four, to share proportionately in any new shares of stock of the same class called the preemptive right. Meaning, whenever the corporation issue additional shares of stock, you need to be given the right to buy X number of shares in order for you to maintain your ownership percentage. This right is very difficult to administer, so some corporations would take this right from stockholders. So that is the conclusion of part 1 presentation of chapter 15.